This is your market update for January 12th, 2026. And today we had the ADP weekly moving average, and it improved slightly from 11,750. That number actually has been really in line with what now that last week's number from the Government Bureau of Labor Statistics for their number. Now, I did my math, and I just want to let you know out there that last year that Department of Bureau Labor Statistics said that the economy grew about 1.35 million jobs. Guess what the final revisions were? Not good. 583,000 when they revised it down, and we still have November and December to go. Needless to say, when you think about it, you go, yeah, almost let's just round up, 1.4 million. And we could be under 500,000 jobs. I'd say we're almost at stall speed on job growth, which is very alarming, frankly. And I can see why the Federal Reserve is saying, oh, we're worried about inflation, but yet jobs are really in our focus. Yes, jobs should be in their focus. And if they wait too late, that deterioration could be really bad. I mean, negative growth. And then it starts perpetuating a cycle. And instead of Fed, doing all the crazy things they do, I think they were quick to raise rates and really slow to lower rates because of inflation. I think they need to actually put a little more gas in the gas tank on lowering the rates right now, considering the job growth is anemic at best. Also, part of the reason why they're holding rates up is inflation. Well, guess what? Today we got inflation numbers. And for the forecast, month over month, it came in what is expected, and it remained at 2.7%, which is not their 2%, but it's been better than the high that we had in inflation over 9%. It's come down. But ex-food and energy, so they have these numbers, this basket, I want to complicate it. When you take out food and energy in that component, then it was at 2.6, so it's slightly better than what they thought. Okay, a tenth better from the 2.7 when you take that out. But here's the thing about it. The big 40% of that component is housing, like rents and housing. Unless the Trump administration just said, hey, we're going to buy $200 billion in mortgage-backed securities to try to drive the rates down. And those are tied with the 10-year, okay, how the 10-year trades. The thing about that is, depending on how long they do it, if they do it for a year, if they do 2 years, let's say they do $200 billion for a year, okay? That should help housing costs and housing prices, because right now the builders are seeing quite a bit of reductions in the prices that they're selling homes for. That's good, and that's not good. There's a two-sided coin. Affordability, when the rates come down, is good because it goes up. I mean, just think about if your interest rate's half, then your payment's going to be half because the rate is half, okay, for whatever you're set up. But on the other side, when you're talking about some people that got in the housing market in the last year or so, let's say in the last 3 years, for the sake of when they started raising rates in March of 22, boy, if they paid too much at that time, guess what? They probably won't. If they need to get out, they're not going to be able to get out of that house without paying to get out of the house, or it's going to be a while before they really build that equity up. If the price of housing keeps dropping. We don't want inflation, but on the same scenario, we don't want deflation. That's even worse when your assets are collapsing, okay? That's harder to reverse than stopping inflation, okay? It may not feel good with the prices you pay, but the worst thing is the things you own start collapsing on you. Guess what happens? You hold on to your money. You don't want to spend. You want to protect what you got. That's how people think. Survival. No different don't forget, during the COVID, what did everybody worry about? Toilet paper. Why? I don't know. It's toilet paper. People are hoarding toilet paper. Beats me. But that's the mentality when prices start collapsing. We don't want that. We want to slow steady with that $200 billion that the Trump administration said they're going to have Fannie Mae and Freddie Mac buy some of these securities to drive the rates down. I'd rather see, and for the consumer out there, you'd rather see a nice, steady Eddie way to go down to keep the market in balance, not to smash it down and then everything starts rolling the other way. It should be a nice gradual coasting to break in the economy.